This video is going to show you how to calculate your debt to income ratio for your mortgage. Now, I'm going to be using a document that you can download and follow along with the link in the description. This comes out of my Home Buying 101 workbook that has a ton of information to prepare you to buy a home, and this is one of the documents that you can use to follow along with and calculate your debt to income. Now, you might be wondering why you want to calculate your debt to income or what it is. And debt to income is a ratio that is used for mortgage qualification, and it's extremely important. It's one of the main factors of qualifying for a mortgage, and all sorts of programs and lenders will have different requirements for your debt to income, but this is a great tool to kind of see where you're at in your home buying readiness and see what you can do and what steps you can take to lower this ratio so that you can improve your chances of qualifying for your mortgage. So there's a couple different ratios that they look at. One of them is called the front end ratio, and one is just your total debt to income. So right now I'm going to focus on the total debt to income, but the front end is basically just looking at your housing expenses. So they'll take your potential mortgage payment as well as the potential property taxes, homeowners insurance, any mortgage insurance, HOA dues, and that will be included in this ratio. So it's usually your front end ratio and then a back end ratio, and there's different qualifications depending on the lender and the program that you pick. Just a quick disclaimer here, just because you calculate this ratio and if it seems like it's in the right range, that doesn't automatically guarantee you're going to get qualified for your mortgage. Every lender has different requirements, and there's a lot of other factors that go into the qualification process. So I just wanted to give you a heads up that this is a great tool to kind of prepare yourself, but you'll still have to get with a licensed loan originator to do a full application and go through a full underwrite to qualify for your mortgage. So I'm going to get started with what is included in your debts that we're looking at with the mortgage qualification. So the debts that are going to be included in this debt to income ratio are debts that are reporting on your actual credit report. So this is going to be any credit card payments, student loan payments, car loans, personal loans, any alimony or child support payments. And just note that not all of your debts or your monthly bills are going to pop up on that. So if you have your insurance bills, your cell phone bills, utility bills, those aren't going to automatically be reported, and we don't include those in the mortgage debt to income calculation. So just keep that in mind. Some of those we might be able to eliminate, even if they're self-reported. Some people have self-reported bills on their credit report. We can eliminate those. So just to give you a good idea of what your bill's reporting, if you don't already know what bills you have, you can download my Loan Advisor app, which is a free app that you can use that can take a look at your credit profile. It's a soft credit pull. It doesn't hurt your credit, but it will give you an idea of what your score is, as well as what your monthly liabilities are. And there's a lot of other cool features and tools in there to prepare you to buy a home. So if you want to download that, I highly recommend it. And if you'll go to this link, you can click this link here. It's clickable. It will take you to this page here. So you can log in and download this on your phone, and it'll give you steps to get your credit profile updated and start to see what your home buying readiness looks like. So definitely recommend checking that out first thing. So once you have your total monthly debts, now this does go on a monthly basis, so we don't look at the annual payments, we look at things monthly. So you'll put that figure in here. And for this example, I am going to run these numbers with like a dual income house. So if you are applying on your mortgage with somebody else, you're going to need to include both of your income as well as both of your liabilities. So you want to get both parties' liabilities added into this figure. Okay, for this example, let's say that the monthly debts, without including your housing expenses, by the way, you're not going to include your rent because that is, if you're buying a primary house, is going to be replaced by your current or the proposed mortgage. So that will get calculated in later. So these are just debts that aren't including your housing expenses. So let's say you have $825 per month in like credit cards, student loans, and car loans. So now I'm going to show you how we can estimate what your potential mortgage and property expenses are going to be so we can add this into this ratio. So I included this link to one of the tools that I have available for my clients where they can check where mortgage rates are today. So this is up-to-date information. It's updated daily, sometimes a couple times a day. So you can click this link and it will take you to this page. And this is where you can see where rates are today. Now, again, this is just average rates. It doesn't mean that you're necessarily going to get this rate, and rates do change daily. So this is not an offer of any rates or terms, but again, this is just to get you an estimate of what your payment's going to look like so we can calculate these figures and get you prepped to buy a home. So you'll go to this page to kind of figure out where you think your average rate is going to maybe be. And usually people will do like a 30-year fixed here or an FHA. So for this example, we're going to go FHA. And good rule of thumb, if your credit score is, if you check the app and you see your credit score is above 620, conventional loan is a possibility. You could go conventional. Otherwise, if you're like in the 580 to the 600 range, likely go FHA, but you can definitely take a look at these and pick one. So do either conventional if your credit is there. FHA has better rates currently. I don't know when you're doing this, but currently they have better rates. And then something else to keep in mind, if you're a veteran, you can use the veteran rate too. So that's something you can discuss with your loan officer. So this page is pretty cool. It gives you up-to-date mortgage rate information. You can keep an eye on this if you're trying to look and see where rates go over a period of time while you're prepping to buy a home. This will always be updated. This link is live, and then it will give you like a little rundown of what's going on in the market as well. So cool little tool to use. So for this example, we're going to go with this 30-year FHA rate. So I'm going to go with 6.5. We're just going to round it to 6.5. So now we have the interest rate we're going to use for this estimated figure. So moving on to the next page, if you've watched any of my other videos, you might have seen the mortgage calculator that I have, but now we're going to use that tool to figure out what your monthly payment might look like. So this is a clickable link as well, and you'll be able to click this to download my Excel calculator that we're going to use. Okay, so here's what the calculator will look like. And you'll be able to fill this in according to what you're looking at. So if you have like a purchase price in mind, you're trying to figure out what you can afford. If you have a purchase price in mind, use that purchase price as well as the down payment amount that you want to put down. So minimum down payment for FHA is 3.5. So we're going to use that. And then we're just going to go with like a $450,000 purchase price. And this will spit out all the numbers that you need. And it's already got 6.5 in there. So this will spit out your monthly principal and interest payment, which was the number we were trying to get. So we're going to use this number for your monthly principal and interest payment. So now that we have that number, what you'll want to do is plug that number in here. And now we need to figure out these other property expenses. So we'll go back up and I'll show you how you can get those numbers. So here's another link. You need to add in your estimated property taxes, homeowners insurance, and mortgage insurance. This is a good little tool that I use to estimate property taxes because that is very dependent on the state that you're in. So here you can plug in just the purchase price, since you won't know the exact assessed value, but it'll get updated based on what it sells for. So put your purchase price in there and just put a zip code, and it'll give you an estimated tax amount. $2,282 annually. And this is going to vary by county. So this is something that's going to be very specific on where you're shopping. So then all you want to do is just take the $2,282 and divide that by 12. And that's your monthly tax amount. So we'll just round to $190. So we'll go back to that page and fill in $190 for property taxes. And now we're going to want to go back up and figure out what your estimated homeowners insurance is going to be. So Zillow and Redfin, you can kind of Google the property and you'll likely find an estimated property tax amount. So just for example purposes, I pulled this listing and you can scroll down and they usually have estimated property expenses. So this is something you're going to shop for anyway, so you can definitely shop this rate. But here's a good estimate. So we're going to use 150 for this example. We'll type in 150 here. And then mortgage insurance. This is where it gets a little bit trickier, but I have the math listed for you up here. So your mortgage insurance rate for a conventional loan is going to be determined by your income level and your credit score and the lender you pick. So if you're putting 20% down, you won't have any mortgage insurance, but if you put less than 20% down, that's going to be calculated on those factors. But for this scenario, we're running an FHA loan. So FHA will always require mortgage insurance and it uses a standard calculation. So for example purposes here, we're going to use the FHA calculation to estimate your mortgage insurance. So FHA mortgage insurance is calculated by taking your loan amount and multiplying that by 0.55% for the annual rate. So since we have a $450,000 purchase price, that's going to be your annual premium. So I just multiplied that by 0.55%. And then to get the monthly amount, you're just going to divide that by 12. So we have 206.25 here. So we will plug that back in down here. We're just going to round. So then to get your total monthly property expenses, you're just going to add all of these up. Equal $3,290. And that's the figure we're going to use to plug that into your debt to income ratio for your property expenses. As I was editing this video, I realized that I was missing a spot for HOA dues under the property expenses. I did mention them earlier in the video, but I went back and edited the documents. So the one that you have downloaded should have the field for any HOA dues. And to recap, while you're looking up property expenses, you can look up on Zillow, Redfin. If you go under the property expenses, they should have HOA fees listed here. So if your property that you're looking at has HOA dues, make sure to include that here in the property expenses, and that'll affect this total number. And in this example, let's just assume that this property doesn't have any HOA dues. So here, now we need to add in those total monthly debts, which you already calculated earlier, plus your total monthly property expenses. So that's going to equal $4,115 per month. Okay, so now we're on this last page where we need to factor in your income. So you're going to use your gross income, which is the total amount you earn each month before your taxes and deductions. So this includes salary or hourly wages, any bonuses or other commissions, alimony or child support payments if you have those, and also any rental income if you do. If you're not a first-time buyer and you have other properties that generate rental income. So you take all sorts of income, and if you have like a second job you've been working for a couple of years, you can include that as well. You do need a 2-year history if you are using a secondary source of income. You're going to take both parties on the loan and all of their total gross income. Okay, in this scenario, let's say one partner brings in $6,000 gross per month and the other partner brings in $4,000 gross per month. So we have a total income of $10,000 gross per month. So to get your total debt to income ratio, you're going to take your total monthly debts, which we calculated this on this page here, $4,115, and divide that by your total gross monthly income. That's going to give us 41%. So typically, and again, it depends on the lender and their qualifications or the qualification requirements, but anything under 50% is going to start to be in the right range. So if you are way above 50%, you definitely need to take a look at what you can do to kind of minimize those debts, maybe pay some off, kind of work towards those goals. But if you're under that 50% range, you're moving in the right direction. Again, that doesn't guarantee qualification, but that's a good place to start. Now, remember, this is the back end ratio, so I can show you really quick how to calculate the front end. And in that case, you would just take your total property expenses, so like the $3,290, and divide that by 10,000. And that would give you 32%. So you're going to have a ratio of 32 and 41 back end. So 32 front end and 41 back end. So that looks pretty good for most programs. So I hope this video was helpful for you. If you'd like a little bit more information, you can always download my entire Home Buying 101 workbook, and there's an online course portion with it as well, with some video tutorials that'll walk you through the entire thing. So that will definitely be a good guide to get you ready for homeownership. Or if you want to book a consult with me and see if you're ready for the pre-approval process, I can either do that with you if it's in a state that I'm licensed in. Otherwise, I can get you connected to somebody on my team who can help you with that process as well. Thanks for watching, and good luck with your home buying journey. If you want to learn more about the home buying process, you can download my free Home Buying 101 workbook with the link in the description. And if you like this video, please like, subscribe, and ring that bell.